Hey there, and welcome to This Explainer. If you've ever thought about starting a business, you've probably realized pretty quickly that doing it entirely on your own as a sole proprietorship has some serious limitations. You only have so much capital, limited managerial bandwidth, and on top of that, you carry absolutely all of the risk. But what happens when you need more funding and diverse skills to really scale things up? Well, you form a partnership. It's the ultimate business team up. Today, we're going to demystify exactly how these partnerships work and, crucially, how we account for the money behind them. Let's just quickly look at our roadmap for today. We're going to be covering 1. The power of partnership. 2. The partnership deed. 3. Managing capital accounts. 4. Partnership final accounts. And 5. Adjustments reveal true profit. Section 1. The power of partnership. So when a business needs way more resources than one single person can provide, it's time to bring in partners. To understand how this works structurally, we look to the Indian Partnership Act of 1932. Specifically, Section 4 defines a partnership as the relation between persons who have agreed to share the profits of a business carried on by all or any one of them acting for all. Okay, let's break that down into plain English. This isn't just about casually working together. It is a legal, mutual relationship where you are bound to share the rewards and, as we'll see in a minute, the risks as well. Plus, every partner acts as an agent. That means one person's actions can literally bind everybody else. At its absolute core, it's really just an association of people coming together for a common goal. Now, individually, the folks in this arrangement are known as partners. But when you group them all together legally, the whole shebang is collectively known as a firm. Of course, there's a specific set of rules governing this firm. First off, the business has to be lawful, obviously. Second, you need a minimum of 2 partners, and according to the Companies Act 2013, a maximum of 50. Third, the whole point is to share profits and losses. And hey, if you don't define a specific ratio, the law steps in and says it's shared equally. But here is the absolute most critical point, so pay close attention to this one. Unlimited liability. The liability of partners is joint and several. This means you are liable down to the very last rupee in your own pocket. If the business fails and the firm's assets can't cover the debts, creditors can absolutely come after your personal property. You are truly 100% all in this together. Section 2. The partnership deed. With risks that incredibly high, especially that unlimited personal liability we just talked about, you absolutely cannot rely on verbal promises. No way. Before a single rupee changes hands, the foundational rules must be set in writing to avoid utter chaos later on. Enter the partnership deed. You can kind of think of this document metaphorically as the prenuptial agreement of the business world. It's a written agreement regulating the rights, duties, and liabilities of all the partners. And sure, while an oral agreement is technically possible, having a written, stamped, and registered deed is absolutely the best course of action. It is your ultimate dispute resolver. So, what exactly goes into this crucial document? Well, pretty much everything. It lists the capital contribution of each partner, the exact ratio for sharing those profits and losses, and everybody's specific rights and duties. It also outlines things like salaries payable to partners and the rate of interest on capital or loans. For instance, and this is a really interesting detail, did you know that if your deed is totally silent on the matter, the Indian Partnership Act dictates that partners get a 6% per annum interest rate on any extra loans they provide to the business? Laying all of this out in the deed prevents misunderstandings and gives you a crystal clear method for settling disputes when they inevitably pop up. Section 3. Managing capital accounts. Okay, so now that the rules are officially set in our partnership deed, how do we actually track the money each partner brings in and takes out? Well, a partnership firm has to choose between 2 primary structures to manage this: the fixed capital method and the fluctuating capital method. Every single firm has to make a call on how they want to track these financial ins and outs. Let's contrast these 2 methods side by side. In the fixed capital method, a partner's initial base capital investment stays entirely constant year after year. To handle all the everyday things, like interest, salaries, or when a partner withdraws money for personal use, which are known as drawings, the firm opens a totally separate current account. On the other hand, the fluctuating capital method is a whole lot simpler. There's no current account at all. Every single transaction, from that initial investment to the salaries and profit shares, goes into one single capital account. And because everything gets thrown in there, the balance of that account fluctuates or changes every single year. And here's a fantastic, super practical accounting tip straight from the textbook. If you're ever looking at a partnership's financials, or maybe solving an accounting problem, and there are literally no specific instructions given about which method they use,
Always assume the fluctuating capital method. It is the standard default for tracking partner capital.
Section 4. Partnership Final Accounts.
All right, we've set up the firm, we've meticulously tracked the partner's capital, and now we've reached the end of the financial year. It is time to discover the true financial health of the business. Preparing final accounts is a highly structured three-step workflow. Honestly, I like to think of it kind of like unlocking levels in a video game. Step 1 is preparing the trading account, which unlocks your gross profit. You then take that gross profit right into Step 2, the profit and loss account, to discover the ultimate net profit. Finally, in Step 3, the whole thing culminates in the balance sheet, giving you a perfect snapshot of the firm's overall financial position.
Let's look a little closer at those first two stages and see how they build on each other. Both the trading account and the profit and loss account are what accountants call nominal accounts. The trading account focuses purely on the factory floor. We're talking direct expenses and direct incomes. If your direct income is higher than your direct expense, boom, you have a gross profit. That gross profit is then seamlessly transferred down into the profit and loss account. This second account is where you record all your office and administrative costs, the indirect expenses and incomes. Once you subtract those indirect expenses, you finally arrive at your net profit or net loss, which is then distributed straight to the partners based on that ratio we established way back in the partnership deed. Section 5. Adjustments reveal true profit. But hold on just a second. The numbers we get from our initial trial balance, they aren't always perfect. To make our final accounts completely 100% accurate, we have to do a little bit of financial detective work. These are called adjustments. Adjustments ensure that our end-of-year scoreboard reflects absolute reality. For example, we might have expenses that are outstanding and just haven't been paid yet, or maybe we prepaid for insurance that extends into next year. We also have to account for depreciation, the wear and tear on our assets, and bad debts from customers who are frankly never going to pay us. We even have to calculate the interest owed on the partner's capital. By making these critical adjustments, we prevent the firm from over-reporting or under-reporting its wealth. And remember, every single adjustment requires two effects in the final accounts to keep everything perfectly balanced. And after all those adjustments, everything finally lands right here on the balance sheet. Drawn up on the 31st of March, this is a statement, importantly, not an account, that lists all the liabilities on the left side and all the assets on the right. It shows the exact financial position of the firm. The partners' adjusted capital balances sit right here, alongside any external debts, proving mathematically what the business owns versus what it owes. So what's the big takeaway from all of this? Well, from the initial drafting of the partnership deed to the meticulous tracking of capital accounts, right down to the final adjustments and the balance sheet, tracking every single rupee is what keeps a business partnership healthy. Good, transparent accounting is the absolute foundation of business trust. It prevents disputes and allows partners to focus on what actually matters, growing the business together. We've seen today how a partnership thrives on a shared vision and mutual trust, but ultimately it survives on accurate, structured accounting. Knowing that you could be personally responsible down to your very last rupee due to unlimited liability, I want to leave you with this provocative thought to ponder for your own future business ventures. Who would you trust enough to share unlimited liability with? Thank you so much for joining me for this explainer. Keep learning, and I'll see you next time.